Greetings, everybody. This is Jeff Scott. This is 12/10/2017. It's 2:15 p.m. Fantasy football is in full gear, but the futures are not open. And this is an exciting futures day as we get Bitcoin futures traded. Should be interesting what that does to the volatility. I entitled today, Buy the Dip. And, you know, it's funny. It made me think back to a time when this was on YouTube.
The market will finally crash and
wipe
out what little
it's funny, it was 2013.
Did you not hear a single word of what
And
I just
in
said?
2013,
Buy the fucking dip.
sorry for the profanity, but I just could not forget this thing. And I went back to it. And if you want a good laugh, you can see who it's by the dip. It's hilarious. But the funny thing is, the female character is talking about her concerns that if she gets in now, because the market's had such a big run, she'll be the last one in and the market's going to fall. The funny thing is, it was 2013. So, it certainly was this past week, buy the dip. What's going to happen this week? As always, this is for education purposes only. I'm a doctor, not a broker. I have no licenses that would allow me to sell you anything, so anything I say should only be considered education. I am independent. No one pays me to say good things or bad things about anybody. Every tool I use, I paid for it sometime. And trading, especially options, involve risks. And you alone are responsible for any of the risks that you and decisions you make. Be your own guru. I like to consider that the basic topic of my trading. And I like to think that I've learned from the Cancelim folks on the left, John Person on the right, Van Tharp for money management, my good buddy George Lee, and I developed my own style. For those that honored me by coming to Palm Beach last week for my live session, or for those online, I really do appreciate it. It really is an honor for people to come and listen to me. I had a great time. Hopefully those found it to be of substantial value. I know I've had a lot of positive feedback. For those participants, there will be an online session, which is limited to those that attended my meeting, and it will be Thursday, and we're going to talk about how I use Thinkorswim this week. What I need in my desert isle, I need a trading platform. I like both TradeStation or Thinkorswim. Last week, in the private session, we concentrated on TradeStation. This week, it'll be TOS. I need HGSI for my analysis, supplemented by EdgeRater. I use all the different seasonality programs, but they're secondary to me. Here's the website for HGSI. What's important about it is a free 30-day trial if you want to try it out. If you do try it out, I have some basic videos that I can share you of how I use it. Frankly, Ron Brown just recorded even better ones that are more up to date. And then under investing strategies, you'll find hundreds of videos from Ron and I and others. Stock patterns are cyclical, and I'm a broken record. Every time it feels like we're running over, we go back up. So you look at this period in stage 2, and what it really is each one of it's just a constant pattern of little pullbacks, and it takes off again. At some point, we are going to go into the sell cycle, and we're going to have to change our approach. But you got to play the market you have, not the one you think you should have. And right now, we've got a pretty rip-roaring positive market. Therefore, I went longer this week, especially after Monday, buying stocks and calls, selling puts. I don't do many cover calls when I'm bullish, nor do I do a lot of, I do bull put spreads, just not call spreads when I'm playing to win on the upside. If I start to get more nervous, I will start to go back into some of my protection strategies, take smaller positions and sell premium. It feels like we're going to probably run up until the end of the year. That's not to say we're not going to have some ups and downs. It's not to say it's going to be a straight line. But the end of the year is in 2 to 3 weeks, and then we have to worry about next year. Friday, just to give you an idea of how bullish it was, think back to some prior sessions where it's mostly red. Everything was working on Friday. It's hard to find something that was losers. Transports were very strong. Gold was a loser. All right, I found a loser. Healthcare and biotech were both strong. Energy, look, materials are medium, but XLE, XOP, OYH all look strong. Financials look strong as interest rates raised or slowly or rose slowly. If we look at what the markets are doing and just pop into Thinkorswim, look at my daily futures, and I'll make this bigger so you can see it easier. Come on, give me my little, open it. All right, so we start with the E-minis, clearly an uptrend. The high was on Monday. They had a red candle high on Monday, 2-day sell-off. That was after the big reversal day, after selling off on Friday. It turned around on Wednesday, end of the week up, not quite to all-time highs, certainly at or near all-time closing highs on the S&P. OBV remains strong. I love to see a clear uptrend with the price above the 17 above the 50, and the 50 above the 200-day moving average. If I look at the whoops, that's the wrong way. Ignore that for right now. If I look at the NASDAQ had a bigger dip on Friday, and I've been calling for it to get close to the 50, and it did. On Tuesday, it closed higher than it opened. It tried to rally, and it failed. It got pretty darn close, 62.25, and it looks within 25 points of the 50-day. And then it rallied Wednesday, Thursday, and Friday, broke above the 17 on Friday with a new PPS buy signal. It's got to be considered bullish. If I look at the Dow futures, similar to the S&P, peaked on Monday, sold off, recovered Thursday and Friday at or near new closing highs. Looks strong. So the markets thus far look good. Probably the weakest of the bunch is the Russell. It had a run up, pullback, a big move up, peaked here on Friday the following week. Thursday, Friday was the big sell-off day that recovered before the end of the day, and then gapped open on Monday, but then sold off Monday, Tuesday, Wednesday. The one up day on the week, well, closing up was on Thursday. They closed up on Friday, but they closed below where they opened. The weakest of the bunch, but still above its moving averages. The VIX, if the markets are strong, the VIX should be a new sell signal, and it is. The VIX is down, not as low as it gets, but it's certainly down as it continues to fail at this 200-day moving average. And then the dollar, staging a recovery, broke above the 50-day moving average. Perhaps the dollar is being supported by the likelihood that there's a additional rate raise coming this week. I'm not going to go and look this time and look at the weeklies, because I think it's pretty clear that we're in a nice uptrend. Back into my presentation. On the weeklies, you can see for yourself. If you notice, we have a white bubble on each of the four indexes telling us that we hit an all-time high this week, or at least a high on this sheet, which would be all-time highs, the VIX down, and the dollar bouncing off the 200-day or 200 weekly moving average. And then just for proof of point, I've got five markets. I got the first column is is E-minis, NQs, TFs, the NYSE, and the YMs. And all of them, you have a long-term on the lower, horizontally, the monthly, on the weekly are clearly in uptrends. And you could see the last 10 days or so, each of them stubbed their toes, but each of them seem to be moving higher. So why were banks up? You can't see it well, but on the weekly interest rate charts, on both the 10-year and on the 30-year, there is a pickup in rates this week, a slight pickup. And again, the Fed's expected to raise rates this week. AD lines, again, for all these slides, the yellow would be the S&P unless I call it differently. The white, hard to tell the difference here, is the indicator. In both cases, the AD line on big and on small and medium stocks is hitting new highs along with price. On Friday, you could see a little bit of the AD pulling back. Actually, this week, just a little pullback. look at transportations, how they rallied, and then the Russell is showing a little bit perhaps weakness, but the AD line remains strong. If I look at breadth, there was a modest change from last week, still strong, not overbought. If I look at the 3-month new high-low, which is sort of my reversal signal, when it gets up to the top, we pull back. When it bounces off the bottom, we go up. We're in neutral, so I'm not expecting this signal to drive a change in the market. And then the daily and weekly McClellans, I don't see a signal here. Nothing showing me that we've had any type of extremes or need for a major change. If I look at the buckets, bucketology, I'm looking at on the right the percentage of stocks in the S&P 1500 that are above the midline of their Bollinger Bands, 60 to 70, 70 to 80. These are very bullish. When I get above 80, I'm a little bit exuberant. So we're bullish here. And when I look at where the buckets are from below the Bollinger Band to above the Bollinger Band, and then every 10% decile in between, where you can see we've got more above the band, the middle than below, but we're not by any means at an extreme. When the greater than one gets to 35 or 40, we see reversals. And as I said, we're nowhere near an extreme here. No evidence of a Hindenburg on the NASDAQ or the NYSE. That's great. If I look at market tone, you could see we continue to have new markets turning green as we've moved out of a choppy market and into a more bullish position. We talked about that last weekend, which perhaps was somewhat surprising considering how the market felt going into the weekend. And then sector strength improved as more and more sectors are turning bullish, again supporting the hypothesis that the markets are improving. Now, the Canaries in the coal mine, which dove once again hard below the 50-day moving average, retook their 50. They're squeezing now. They're at a place where they could break out either way, fail or break out to new highs. I expect them to do something this week, although as we get closer to the end of the year and volume dries out, maybe we become less convinced that they're going to do something. Now, the Scott Index, which I built back in June, of leaders back in June, really has never sold off, and frankly, it's about to take off. It had a PSA reversal and a squeeze with a kahuna last week, so this continues to show strength in the broader market. Know your news and earnings dates. I've sort of highlighted the key here. FOMC announcement, 2 p.m. on Wednesday. Everybody's expecting a 25-point basis raise. You can see note auctions, a jobs number on Monday. The Fed will dominate Tuesday and Wednesday, although you'll see some CPI and some petroleum numbers, jobless claims on Thursday, some note sales, and then Friday, Empire State manufacturing and industrial production and the Baker Hughes rig count. Not a horribly busy week for news, but whenever you got a Fed announcement with an anticipated raise right in the beginning, you sort of going to put it down there in the lots of news category. Here's the earnings. Clearly, the earnings are slowing down. This is just some of the bigger ones. Costco is a big one, Oracle, but a slowing earnings week. I know on my stocks, I don't think I have any earnings this week, so clearly we're getting near the end of earnings seasons. Market thoughts, buy the dip remains the play of the day. That was the first opinion I had when I looked at the market. When I turned the market on, when I looked at it, I thought, this is just like 2013. And the buy the dip worked until it doesn't. Employment numbers surprised the upside. You had a rally in Asia, and Brexit agreements fueled the week-ending rally. Bitcoin futures, already mentioned, may be a distraction. Fed announcement on Wednesday, everybody assumes 25 basis points. I highly doubt they don't change it, but imagine if they did a 50 basis point move. That would perhaps telegraph that we have something coming in inflation, or they're concerned about too much employment. I don't see that happening. I don't see the Fed making that drastic a move before Janet's exit, the Jexit instead of Brexit. And as we get ready for Santa and a tax bill, my guess is we just meander into year's end. I might be concerned, or I am concerned about what happens early in the year. So I will probably use rallies into year end to probably take off some of my positions, not necessarily go defensive, But right now I'm hanging in the wind. There's a Super Bowl, and that may not be great on January 3rd, 4th, and 5th. Tonight's agenda will be the usual top-down review. Once again, thank you so much to those folks who wrote a check, paid by PayPal, and actually came to my meeting or participated online. I think we can do better from a technology perspective, but for my first live streaming event, I'm pretty darn happy. I've watched the 10 gigabytes of streaming video, and yeah, you always wish you could go back and change a few things, but all in all, I'm pretty happy about it. So again, thank you for coming down. Now on to the charts. As always, I like to go into TradeStation very quickly and take a look at some of the indicators on the markets that I like to look at. So let's go in here, and very briefly, I'll go deep in the first one and then very quickly look at the others. Start with the E-minis. I'm going to look for 6 things. Number 1, are we in a buy, sell, or a sell on the John Person PPS signals? These are great buy-sell signals, and I use them every day. I am clearly in a buy all the way going back to the middle of November. I'm in a weekly buy. I'm in a monthly buy. So very strong market. No shocker. We already know that. Second thing I look at is the color of the paint bar. Green, green, and green. A green paint bar means it's safe to be buying still. If it's blue, I can be holding it. I could be buying it. I could sell it. It's a neutral signal. But if it's red, it's not safe to be buying. I should be thinking about going short. So we're green across. The third thing I look, I see these little red dots on the weekly, which tell me the weekly is probably getting a little extended and that there's some MACD divergence. If that's the case, that might be concerning. That's one demerit, but we've got a lot of positive things here. Then I look at number 4, how are we within the auto envelope? And on both the weekly and the daily, we're above the envelope. And I know from historical that doesn't mean it's coming back in. Probably it means it's going to slow down and maybe go sideways. The fifth thing I look at is my weekly bongo, which is the middle dot here. That's green, that's supportive. And then I look at the high jump bar at 78. It's not telling me we're too extended, that we have to come back. So of probably 3, 6, 9, 10, 12 different potentials, the only negative is the red dot here. So that's 11 out of 12 positive. I think the E-minis are super strong. I look at the NASDAQ futures. I see a new buy signal. On the blue, you can see it's come down a little bit here. It's a little weaker on the weekly with those red dots, but still super strong. Blue on the monthly, but in a buy signal. We're right in the middle of the channel, which bodes well. Our high jump is low. Our bongo weekly is green. The daily's red, which just tells you we were in a pullback. I think the NASDAQ is poised to go higher. All it takes is news to change what I think, but right now I would err to that side. The Dow futures, again, in a buy signal in 3 time frames. The blue is, and the red dot here, again, shows me that this is a little bit extended. It's above the envelope on both the daily and the weekly. The bongo's fine, but look at this. Our high jump's at 87. That means this is the most extended it's been. Well, 87% of the time it's been less extended. So can it get more extended? Absolutely. Will it get more extended? It probably will. But right now, I have to be a little concerned that we've run a little bit hard on the YMs, and you can see it also above the envelope. So this is, in some ways, the strongest from an extension perspective, but I'm a little bit more nervous about the YM. The Russell futures, in a pullback scenario, I got a PPS sell signal, but a blue bar here. Weekly and monthly are buys. You've got the MACD divergence here. 8 at 60 on the high jump. It got up to about 90 a couple weeks ago. So the Russell clearly looks different than the others. Will it lead the others down, or will the Russell turn around and go up with the others? I'll go with the latter. And then if I look at the dollar had been beaten down, and you can see it's got a new buy signal here on the daily. But is that a retracement in a downtrend, as both its weekly and its monthly are still in a sell signal? The high jump is fine. The weekly bongo just turned green. If I look at the VIX, I can see the VIX is under pressure. Daily, weekly, and monthly are in sell signals. And if I just want to take a quick look at the yellow metal gold, You can see gold is sold off hard. It's in a sell signal in all three time frames. It's got red bars. You certainly don't want to be going new long positions in gold just here, although perhaps it's getting closer to a reversal. The high jump's almost as low as it gets. But I'm not going to buy a falling knife. I'm going to wait for it to bounce and start to head up before I'd even consider. But gold clearly looks weak. If I go into HGSI, I always like to look, just because not everybody has TradeStation, at some of the indexes in HGSI as well. I use the Woodward and Brown user groups, Major Market Plus, hit the warehouse view, and then let me just size things a little bit better. And then I use the top-down view, which is just price and volume, mostly weighted to Friday. And we can see that raw accounts, biotech leading the market, volatility gold, semis gold, and the small stocks on the bottom. That's interesting, a bifurcated market, but not surprising based upon what the Russell futures showed. Let's look quickly at what we see in the major indexes. I know you're thinking, I never do anything quick. You're right. Here is the S&P, obviously in a nice super bull market. Bongos are green, no Hindis. And what's interesting is, to me, is I keep thinking we're going to come back and visit the 50 and we keep going higher. I promise, I guarantee, I stand on it. There's no question that we will someday come back and hit the 50-day moving average. I have no idea when. I keep thinking about it, but I'm not going to react to it until we actually start having some down days in a row. And then the question will become, is that just going to set up another buy the dip buying opportunity? So that's the S&P. Look at the Dow. We said this is super strong. You can see, and how many times do I talk about the quick pullbacks and the bounce and how we're overdue? You can see that the high jump bar maxed out on this bar up here, and that's led to a little bit of a sideways move. I look at the NASDAQ overall. Again, same pattern, nice uptrend. 8-day magenta, 17 simple, 50 simple, 200 simple. And price is really above all of them. The magenta and the 50-day are kind of overlapped on the last bar. Super strong. The red bar just tells me it closed lower than it opened, and we have a little pullback here with the daily bongo red. And then the Russell 2000, which has been weaker. You know, this one did pull back. This one actually pulled back to the 200 here, the 50 and the 50. So you do get pullbacks, and again, we are guaranteed of one thing in this world, and that is that we'll have pullbacks again. If I go up and I look at NASDAQ Biotech, I was excited. You're going to see my pick of the week, or one of my picks of the week, is a biotech stock. Nice pullback to the 200-day moving average, and then a big move off on Thursday and Friday. Kahuna's 2 days in a row. Weekly bongo still red. All I got to do is close about that 50, and we're going to get close very soon to that weekly bongo changing. I think that looks super strong. The dollar, you know, bouncing around on a low, certainly on an uptrend over the last 10 days. Still got some major resistance and overhead supply above it. The VIX, as we mentioned, is weak, and you could see the VIX continues to come and fail and come right back down. And then probably some people are interested in gold and silver, and gold is weak, below the 200, and silver is well below the 200. There will come a time when it's good to buy gold and silver. I just don't think that time has come yet. And, you know, I still favor stocks today over gold and silver, in my opinion. Next, I like to look at the major industry groups and go into, let's see, move those over. I've got 174, and I can see with 2-day force, which is what I like to use for looking at momentum, 64 to the upside, including some of my favorites, and to the downside, only 15. So interestingly, looking at some of the ones to the downside, because they don't all feel weak. Semiconductor devices have been weak, and you could see Broadcom. Is Broadcom a short in here? Well, I think Broadcom is at a very critical juncture as it's sitting on the 50. Now, it's been a buy the dips in the past, but I'm going to be watching Broadcom close. I have a small position left in Broadcom. I have a spread. Also weak, Qualcomm, which turned them down when they offered like $80 a share. Analog devices. So semiconductors are weak. Banks. Now everything's below the index. I thought regional banks were firming up. And I think some of the regulatory reform is good for them. I typically trade the KRE to avoid name risk. And the KRE looks a little bit better than the stocks do, but not necessarily in a go out and buy time. So we'll see what the banks do. And then continue on the weakness, semiconductor manufacturing, just to get an idea. And here's Applied Materials, which I used to own, got stopped out, and you could see it's come down a little bit from the 60 range and is now trapped between the 50 and the 200-day moving average. Still has great earnings, so perhaps that will give us a recovery opportunity. So I look at these just to point out semis, banks, casinos, tobacco, entertainment are weak, healthcare supplies, healthcare services. Some of these groups have been strong over a period of time. If I go to the 2-day force up and I see what's working, I see where I like to play biotech and specialty pharma. The American Society of Hematology meeting was this week, and I was just coming back from Atlanta. Except for the snow, it was a great meeting, so you may hear some news about Celgene and some of the other companies, a lot of small companies. Exploration and production continues to be strong. Services are in the top 10. Apparel made it. Ads did, diversified the big banks. So let's just very quickly go through and see if we can find any nuggets. So Sage had some positive data. So this is why people like biotech. This is the best of biotech. The stock currently has a market cap of $6.8 billion. It had a market cap of about $4 billion when I went to bed Wednesday night, and then they had positive news come out and a major run. This is the best part that can happen with pharma. Now let's talk reality. Reality is they get bad news too. So it's somewhat rolling the dice and playing Vegas. You can get some outstanding moves, but you also can get some moves to the other side. So Sage looks strong, but do you really want to chase this? It's a viable gap up 60, 70 points. I think I would pass. Alexion, it was on my crap list and really looking bad, and now they're getting shareholder pressure to do something strategically. They also have a potential competitor in trials now to their Solaris franchise. I can't ignore the fact that it looks like a bottoming pattern. It gapped up on Friday, mobile breakout squeeze, a pocket pivot, and a kahuna. So this is probably on the basis of shareholder dissent and hoping that management does some changes to boost stock price. Celgene, I have a position here. I bought it on the drop, buy the dip. Trouble was, could have bought it on 2 different dips, but I think it's done going down. It's got earnings per share growth greater than multiple. It's got a little bit of a move up on Friday, mobile breakout squeeze, pocket pivot, and kahuna. I've been out of Celgene for a while until recently. I like the company. I like the leadership. I think it's time to be going long Celgene again. Gilead. Gilead made a big acquisition in oncology for Kite. That made me a happy man because I had a significant position in Kite, and they bought it for like $180 a share. Is that enough to turn around Gilead? I doubt it, just based upon the volume of patients that will be treated. They spit off a ton of money. They made another acquisition over the last week or so. So do I think it's a great growth stock and it's going to be a long-term winner? Maybe, maybe not. But is it done going down? It's resting on its 200-day moving average. Had a kahuna come in Friday. you know, if you like bottom fishing, buying quality things cheap that pay almost a 3% dividend, Gilead is probably not a bad buy here, especially if biotech is small. Immunomedics pulled back to the 200 and broke out on some data at ASH. Vertex, don't like this one as much. It's clearly in a downtrend. Here's one I do like a lot. So let's spend a few minutes with Biogen. If I was still doing my stocks of the week picks, I would have talked about buying Biogen IDEX. So let me give you the bullish case for Biogen IDEX. If I go to a weekly chart, it is pretty clear to me that Biogen has been relatively flat for a long time. If I go to a monthly chart, you can see that at one point, Biogen from 87 up to 450 was the darling of the market. I don't know if I would say they stubbed their toes versus as much as concerned about pricing and orphan drugs that they're having to deal with. But when I look at Biogen IDEC, I see a stock that was in an uptrend from June until October, has pulled back, and now it's having a move off the 50-day moving average in the setting of a strong group, a kahuna on Thursday, a mobile breakout from a squeeze, and a weekly bongo. To make it even more attractive to me, I always go into TradeStation and look at it with John's stuff, John Person. We spent a lot of time with that on a webinar this week. And let's just go into this one because it made it to a list of my stocks of interest for the week. I thought it did. Let's see. It should have done. All right, all right, this can't be this week. All right, this is, it's not 11/26. All right, that's why it's not there. No worries. I can just add it to my list here. In fact, let me just do that. I'm going to pause it and open up this week's list. Okay, I'm back. And if I go to my buys, I should see Biogen IDEC. If not, I screwed up again. There it is. So these are some of the stocks that I looked at. I already mentioned Celgene. These are some of the ones that I'm going to look at closely this week. Let's show you what I liked about Biogen IDEC. So this is John Person's indicator set with a few added things on. One of the things I've added on are trend line support. So you could see on both the weekly and on the daily, two things. We're in an uptrend again because the trend line is pointing north. And the other thing is that we're coming off a trend line support. We have a weekly buy signal a week ago and a daily buy signal this week. We are coming out of a squeeze on the daily, which I like a lot. If you look at volume, you look at the VM indicator, bongo's green, you look at the relative strength, Biogen IDEC is going the right direction in the daily, and even the on-balance volume on the weekly is strong. So I see a stock here that I think is based. I think the group is strong. I think it's going to run. How would I play this? So let's talk a little bit about that. It's one of the things I did that was a lot of fun at my meeting. So let me get a piece of paper and a pen here so I don't confuse me while I'm confusing you. So the closing price on Friday, this is an expensive stock, was $325.77. The high was $327.55. The low of this mess here, let's look at this day, is 306. $39. So I've got no interest in letting this stock get below $306. So at 327 to 306, it's about a 7% delta. So I'm okay with the risk-reward ratio there. Now, it's in a squeeze. So if I was to buy outright the stock, I'd probably put an order in that says if Biogen IDEC trades above 311.70, so I'd buy it. Hold on, wrong date. Go back here. If it trades above 327.55, I want to buy it. I'm going to put my stop at, say, about 306. That means I'm risking $21.55, which, let's just do the math. It's not, hold on one second. It's probably a little bit less than 7%. So I'm going to look at 327, and I'm going to take 21.55, which is the risk, into 327.55. So I'm looking at 6.5% risk if I'm willing to take that trade with that stop. Now, to be very honest with you, I would take that trade all day long. I like that trade. A 6% risk is something that I can clearly live with. In fact, it's actually pretty good from my perspective. So I would probably have my stop on that arrow. I would probably put my buy signal right above the close of the day, which is probably right there. And I would set my target at 21, because of the cost of the draw, 21.55 above, probably around 350, 348 would be my target number one. So my target's going to be right up in here. So my goal would be to buy the stock at the open, and on 1,000 shares, this is where we're going to do some math. 1,000 shares would cost me $327,000 and $550 for 1,000 shares. I would be risking $21,055, and my first target would be a 1-to-1 ratio, or a profit of $21.55. All right, so that's how I would look at playing it. I'm not sure that's what I want to do. So I'm going to open up my options profile, something that we did play. Hopefully you can do it without updating it. Let's see this. Something we played a lot with at the meeting, because what I can do is start looking at some ideas. Now, I want to find an options strategy that would allow me to buy Biogen IDEC with a smaller investment and a smaller risk, but I want a big gain. And let's give it 1 month time frame, and I want to be bullish. So I'm going to look at my potential spreads, and I'm interested in a bull put spread. That's one of the things I like to do, where I sell a near-term put and buy a put further out of the money to protect myself. I just keep the premium. I like that. A bull call spread on an expensive stock might make sense. Buy a call at the money and sell a call $10 or $15 out of the money. That might make sense. I might want to do long a call, long a stock, and or do a synthetic long. So these are the options that I gave myself. Now I want to go up, minimum range, make it $10. Okay. So what I have here are 5 traditional strategies that I might take. If I buy the stock, what this picture tells me, doesn't look like, that's not buying the stock, that's buying the call. If I buy the stock, then if the price goes up, I make money. If the price goes down, I lose money. So to buy 100 shares now, we're going to use smaller numbers for this argument, it cost me $32,577 to buy 100 shares. I have infinite profit opportunity, but I could lose my entire investment, and my break even is at the current price. All right, well, that's interesting. I like doing a synthetic, but a lot of people won't be able to tolerate that. And the synthetic will look, I hope you will agree with me, that the synthetic looks exactly the same risk curve. Okay. All right. Sometimes all right, we good? All right. So the synthetic has the same P&L risk curve as buying the stock does, infinite profits, break even is the current price, and I have to pay $160. So if you haven't figured out the benefit of this is the break even changes minimally because there's a cost to the option that I'm buying at $1.60. But the price to loss curve, the gain loss is exactly the same. I have the same risk as I did if I went long the stock. I have the same profits, but instead of controlling 100 shares with 32,577, I can control 100 shares with $160. So let's put this one, move this one down to our review. What if I bought a call? Buying a call is cool, because if I buy a call, I get all the upside in my purchase. All right? Infinite upside. I have a big upfront expense to buy the call, but all I can lose is that $1,115. So I've maintained all my upside, but I've reduced my downside. That's not a bad way of playing an expensive stock. Now, the bad news of this trade is I have to pick a duration, and I might have the right idea, but it may take too long to get there. And it's a pretty expensive call to expire worthless. But that's a trade I would consider. A bull call spread, I hate this trade in a bull market. What I'm doing is buying a call at the current price and then selling a call $10 away. So the max I can make on this trade would be how much? It would be $10 minus the amount of premium I had to pay for the trade. So if I'm paying $450 or $450 an option or a contract, then I can only make $550 because it can only move $10, so that's $5.50 left because it's going to cost me $4.50 to buy it. Now, the benefit of this trade of a bull call spread versus a call is simple. In the call, I had to come up with $1,115 and maximum risk of $1,115. In the call spread, I only had to come up with $450, which was my risk. And then the last of the traditional strategies we would talk about might be a bull call spread, a bull put spread. Here I'm saying, I know the stock's going up, I just don't know how far. So what I'm going to do is I am going to buy or sell you a put at the money and then buy a put underneath. So the expensive put is the one you're buying, so I'm putting money in my pocket. And my expectation is that this is trading up. So if it trades up, your bull put spread for you or my bear put spread will expire worthless. So this is a trade that is different in that to do this trade, I will get money in my pocket, $370, but I've capped my gain at $370. I've capped my loss because of that put spread. So the most I can lose is $6.30 a share or option. So my capped loss is $630 per 100 shares. So I look at these, and here's my challenge. I want infinite gains. I like the fact that my maximum risk is lower in a long call. I would like to see if I can make that risk smaller or make my out-of-pocket more expensive. And the way I do that is I do a modification of a synthetic. And what I like to do is I like to take that same synthetic, which is buying and selling a option at the same strike price. And what I'm going to do when my computer stops being mad at me is I'm going to edit the spread. I'm going to add an option, and I'm going to buy, say, a 300 and let's look first at 320 put. So now what I've done is I'm selling a put for $9.55, and I'm buying a put $2 cheaper to protect me. so I don't have an infinite loss. Now, I'm not sure that's the right one, and when I look at it, I see a couple of things. Does this make sense? That's not a sell. That is a buy, so that's why did it make sense. All right, perfect. So I'm spending $8.95 per 100 shares versus the $11.15 on the call. It's a little bit better, not great. My maximum risk here is only $280 more than it was on the long call. I like that. So I'm saving money on the ups in the beginning. And then my potential gain is infinity. And then compared to the long call, you can see where your break-even point is. I only have to move $8 to break even versus $11. So my trade that I like to take is this. I called it my meeting, my chicken shit synthetic. It's basically I buy, if I'm bullish, I buy a call and I sell that put spread. Now the other play on this could have been, and watch the debit and watch the risk. I could have said, no, let's buy a $315 protective put. So watch the debit. Now I spend less money, but at more risk. But that's how I would evaluate this trade. And I think what I'm going to do is I'm going to put an order in, but instead of buying stock, I'm going to go and put an order in on my chicken synthetic and see if I can't get filled. And then how I'll manage that is, it's a double long position. The long call, all I can lose is my premium. The short call, I can lose more than the premium if it goes against me. So typically I'll take the short, not the short call, the short spread, not the short call. The short spread, I take that off when I get at least 50% of my max gain, and then I just ride that long call as long as I can. So Biogen IDEC, you can tell I like Biogen IDEC. Juno, I like Juno as well. It's a CAR T company just like Kite. It bounced on the Kite news and continues to trend higher. Regeneron had some positive news. Looks like it's bottomed. Clovis had a move up on Friday as well. Bluebird Bio, another CAR T. You can see how strong it is. Biotech to me looks strong. I would be looking at Celgene, Biogen IDEC, and maybe Gilead, probably less likely Gilead. Or I could say, screw it, I'm just going to buy LABU. That's how I play biotech. And if I break above 50, you might run all the way up to 95. Two kahunas in a row, a mobile breakout from a squeeze, and that's why I'm currently playing LABU, which of interest, pull back and touch the 200-day moving average. So that's how I evaluate each stock I'm going to take. Specialty pharma, I can't help myself. I've got to buy Valiant. Valiant, and that's what I actually use the I can't help myself trade. It's not at a good buy point. It's already broken out. The good buy point would have been the test here, maybe a test here. But look at the strength in Valiant off of its bottom. Now, those that have been around more than a week or two know that Valiant used to be a $250 stock. They've been selling off assets. They've been righting their ship. This is something where, I might go into Thinkorswim, go into trade, look at Valiant, VRX, and look at some long-term options. Maybe buy some options from, let's see, January 2019, let's say $25 options. I don't think this is a story about whether Valiant goes from 19 to 25. I think it's a story that once they right the ship and divest some more assets, it's a $40, $50, $60 play. So what I'm thinking that I might do is I might look at this and say, I'm going to buy for $2.87 the right to purchase for each call option 100 shares of Valiant for $25 before the third Friday of January in 2019. I just have a sense that this one's going to recover a lot. And so I could feel like a millionaire. I could buy 4,000, 5,000, 6,000 shares at $2.87 or less and control stock for a long time. And that's something I'm going to look at doing this week. A different story and a different expectation than necessarily let's see what's going to happen here. A different story than Biogen IDAC, which I'm buying for today, but I think it's a very interesting opportunity. All right. What else looks good? Radius, still in a downtrend. Madrigal, don't know anything about these guys. Nice gap up. Marinus, I suspect by the name they're a marijuana company, but I should be careful before I say that. I bet they're looking at, well, they have a drug called ganaloxolone, so maybe they're not a marijuana company. There's a number of healthcare companies with medical marijuana developing drugs. That's not a negative, it's a positive. Global Blood Therapeutics, we talked about it back here. That was the time to buy. It's getting extended, although high jump doesn't show a problem yet. So and then Sucampo's trades is a takeover speculation. So in this group, I think the big winner is Valiant. Oil exploration and production, take your pick. The patterns are not that dissimilar. I like looking for stocks that are already broken above the moving averages. So Noble to me is a laggard, but it had a kahuna and a couple pocket pivots. Devon is one I'm playing. It's pulled back to the 50. A pocket pivot, a kahuna, in a squeeze. This would be a perfect launch place for Devon Energy. Has earnings. ConocoPhillips, great earnings per share, 2% dividend, sitting right on a convergence of moving averages in a squeeze, had a mobile breakout and a kahuna. That one looks attractive. Whiting Petroleum below the 200. Here's another one, Marathon, pull back to the 50. Looks like it wants to go higher. So I think you'll find a number of oil exploration stocks look very viable. E-commerce discretionary, 'tis the season. Look at each of these three because a lot of people own them, and then I want to comment about Etsy. Alibaba, it's below the 50. I think it's going to come back up. It's got great earnings per share growth. I probably wouldn't buy it until it makes it and closes above the 50 and not let it get too far away. Netflix, very similar picture. We're getting to the season of Netflix. I always like seasonality with this stock, and maybe I'll be nice and talk about it. Amazon, unlike the others, it's off its highs, but it's above its major moving averages. Pausing here to refresh. They already said that Black Friday was bigger than Prime Day, so should tell us something about what's going on there. I want to talk about Etsy. At my meeting, somebody brought up Etsy, and I talked about it's bounded by some trend lines, and I'd be looking for a breakout. I'm in Etsy now, but I didn't buy Etsy until it broke about $18 because I wanted to make sure it was going to get out of a trading range. Etsy's got great earnings per share growth. It also trades at a high PE, and I like that one as well. Specialty apparel stores. These are back. So take a look at the first couple, and I think you'll see some things that are, maybe they're getting too far away. Lululemon, Bible Gap up on earnings. I put that high jump, too far away category. L Brands, a little bit of a flag here. Look at the group strength here. I think it's buyable. Big dividend, not great earnings. American Eagle Outfitters, one of my holdings seems to be breaking out here. It's probably moved a little further than most people would want to chase it. Burlington Stores has been strong for a long time, although it's recently gone sideways. This used to be a big leader here from 40 all the way up to 100. Now a cup handle and a breakout. So a lot of strength in retail and apparel. Communications equipment. Arista Network has just been a super strong stock for some time. Like a lot of others in the technology world, it's pulled back to the 50 and struggling to get back up. I wouldn't be long here I wouldn't buy it until it breaks above that PSAR. I probably wouldn't hold it if it breaks down below the 50. A lot of stocks have been breaking down, rallying, and then selling off. Let's look at Apple. You know, it kind of reminds me a little bit of Amazon in that it's above most of its moving averages, going sideways. I just don't know which way it's going to go. I know that my $160 iPhone I thought broke today. I had to do a hard reset, which I hadn't done before, so don't like to see that. But the fact that I bought a $160 phone is probably the most, a $1,600 phone is probably the most bizarre thing. But they make it feel easier because you pay by the month with no interest. Oil and gas services. I look at these two. I want to own something here. I just don't know if I'm ready to own these. They are clear-cut downtrends. This is Schlumberger. They have such big volume that every time they have a minor bounce, you look at their 11 million shares on Schlumberger, they come to the top of force. Halliburton, similar story with 8 million shares, clear downtrends. I'd like to see them above the 200. And then I look at doing this. Let's look at my modified force. And see the only stock that has positive, higher volume over the last 2 days than they did in the past, so positive volume was Schlumberger. I don't see this. I am interested in these two here. Smart Sand, is it a high growth stock? No. Why do I like this stock? Because sometimes I'm a sucker, and I think about the fracking plays. This may not be the best of them, but the fracking plays have had huge sell-offs, and maybe it's time to consider one of those. There are some that pay a dividend, fracking sand. But here's a refiner. Refiners were extremely, this is their logistics. Never mind. They have a refiner that I was going to show you. All right. Generic Pharma made the list. Teva's a beaten down stock. Is it done going down? It broke above the 50 with a kahuna. This is a 4.5% dividend. Here's a stock where I couldn't fault you of buying it, putting a stop below the 50, and holding it as long as it stays above the 50 and trying to collect some dividends. It's got huge dividend opportunity. Like that one. From a dividend story, I don't like the chart pattern. It's not what I call a high growth stock. This looks interesting. Mylan, as you can see here, pocket pivots, kahunas, mobile breakout from the squeeze sitting on the 50. I think they had some news about a biosimilar. Let's see. Biosimilars would be generics on some of the expensive Genentech biologic drugs. That's actually very exciting. So it's a chemotherapy drug that was approved. I like Mylan here. I think that it's been sideways for a long time with some volatility. I'd rather be buying it down here than up there. But why is it that I like it here? I like it here because it's breaking above in a squeeze with a mobile breakout, squeeze, pocket pivot, kahuna, bongo's green, and breaking out after a base that's been going on for months. I like that one. So Mylan looks interesting to me. Infrastructure software, is anything that I really liked. Then diversified banks. Bank of America remains my number one in share number, although it's not my dollar value. That would be Amazon. But the big banks, whether you're looking at Bank of America, Citi, it doesn't look as well. That must not be the right one. What is Citibank's? All right. JPM. I know that one. They're all stocks that have had nice run-ups. They get shallow pullbacks. and they keep going higher with tightening interest rates, reduced regulation, although that's supposed to help the small banks more. I look at these, I like them, and I still like Bank of America. And I did want to show you that one refiner. Let me show you some of my favorite picks from my bottoms-up approach. So I'm going to go into my buy list. Now, there's various reasons why I like these stocks. I'm not saying by any means I'm going to buy all these stocks, but these are some of the stocks that made my interest list this week. And they made my interest list for various reasons. Here is that refiner, Endeavor. Never heard of this guy before. I don't know if there's a new name to an old company. I'm thinking. But here's a stock, nice uptrend, pull back to the 50, multiple pocket pivots and kahunas, a new weekly bongo, breaking out, great earnings per share growth, pays a 2% dividend. I like that one a lot. Another oil gas play, this is Carrizo. It's squeezing, pocket pivot, kahuna, mobile breakout from the squeeze, weekly bongos green. If this thing closes above the high of that day, then it's clearly broken above its moving averages, and that will be interesting to me. So it's not a buy yet. Hot Crush Partners is one of those sand companies, and this is one that used to be a very expensive stock as well. Here it was $70. Today you can buy it discounted quite a bit at the $10 range. And is it done going down? I don't know. I get the sense that there's a lot of things going on in fracking. I look at the earnings per share growth, and I say to myself, if you add $1.09 and you knock off these 2 quarters, which was 28 or 18 cents loss, that's $1.27 more earnings. $1.27 plus 32 is $1.59 plus 18 is $1.77. If I have a multiple of 30 and I have $1.77 of earnings, it's a $50 stock. If I have a multiple of 20 and I have $1.77, it's a $34 stock. So I'm not buying growth, I'm buying value, and I think that that looks interesting as well for that reason. If I was to buy an oil company, I've been looking at nibbling on Ecopetrol for a while. High base, breaking out on Friday, pays a 1.3% dividend, also has super high earnings coming into the stock. And then another in the biotech world, one of my favorites is AbbVie. And you could see a nice run up, sideways move, pocket pivots, kahunas in a squeeze. Not as much earnings per share growth, doesn't pay at a big premium to that, and pays a 2.7% dividend. So I've now done my top-down review. I've looked at some of the things that interest me. I did a detailed analysis about how I might look at a stock, Biogenidec. Now let's make a few comments before we're done about seasonality. So at my meeting, I had issues with seasonality because the programs were doing upgrades or updates. But let's see if Seasonality Trader is going to help me today. So this is a calendar, and I like big wins. So I'd want 90% likelihood and a minimum of 10% move. And I only want stocks who are having seasonality around earnings. And this is going to give me, for this month, going into next month, some of the different stocks that I might want to investigate around earnings. So I'm going to look at January 2017, and I'm going to find somewhere in front of my face Netflix. So Netflix had a score on the calendar of up 9 out of 10 years. On the up years, the average return is 31%. And I want to look at Netflix. I don't know if the program is going to cooperate. Here's Netflix. So what does this show me? This shows me in yellow, a 10-week seasonality. That's the average move over 10 years. In green, the last 5 years. And let me put on a couple of things that I like here that are not sitting there. All right. And I would look at it from where we are right now, and I would try and get an idea of what I think is going to happen. I don't want that. I didn't like how that came out. All right. So one issue is Netflix in an uptrend or a downtrend? And I think we're at a position here where it's in a downtrend, but it's at the lower half of that downtrend. So I'm going to go and do this. All right, there you go. So if I go in a very short time frame, it's actually got a 50% growth rate up. It's right in the middle of a tight range, although I'm not giving it a lot of time. And when I get up here, this green bar here tells me that there's strong seasonality, which I know from the yellow and green line. When I look over here at 10-week seasonality, I see that if, that's not the one I want. All right, what I got to do something. I got to make a bit of an adjustment here. Let me see if this one's writing it. Let me try one more. All right. So January 22nd to March 2nd, 9 out of 10 years, 29%. So now I want to know, when is their earnings date really going to happen? So I'm going to go here and go, when is EPS date, Netflix, Jan 2018. And the beauty of the internet is someone's going to tell me. So I see right here that it's January 17. So I can't wait to the 22nd, in my opinion. Here it says the 24th. So I'm going to have to look around, and here it says somewhere between the 17th and the 22nd. So I'm going to have to work hard and figure out the exact date. Because based upon my remembrance is immediately after earnings, the day after, the stock opens up and has a big up move. And this here with the green stacked up on just a little bit of red shows you the differentiation of up versus down days post earnings. What I see here tells me I want to be long Netflix going into earnings. Now, if I look at Netflix's stock, I don't want to be long Netflix right now. So what I'm going to do is I'm going to remember, I'm going to put in my Outlook calendar. So I'm going to go into my Outlook. And this isn't my trading computer. This is just the computer I do the videos on. But I might go into my calendar and go to January. You might be able to figure this is my work computer, and it is. And go to January 15th and say, verify Netflix EPS date and considering strong seasonality, consider taking long position. Now, it's been right 9 out of 10 years. It doesn't mean it's going to be up this year. But I just set myself a reminder, and that's how I will get ready. And based upon what Netflix is doing, I will strongly consider a position. Last year, for example, so what's the best? If we look at the best program, I think for looking back would be Best Choice. So let's see. All right, let me just go into my website here and go to. If we go to Best Choice Software, that's just another of the seasonality programs, probably the older of the ones. And put in Netflix, which And now I'm going to put the seasonality chart on, and I'm going to look at the beginning of the year. It's going to tell me that I want to go long on the 21st, sell on the 24th, 12 wins, 1 loss, holding it 14 days. You win 92% of the time. And this is the performance on an annual basis. All right, why is it not coming all the way down? Let's see what happens when I do this. Well, it should go all the way down. Let me make this smaller. Oh, because it starts at the top. My bad. I was looking. All right, so what it's showing me is here's the stub year, 12.64 down in 2016. But these are some of the moves that it's had, points and percentage, points and percentage. And you could see some pretty big percentage moves. And playing options, you can make a lot of money playing Netflix at that time. Well, we've done a lot today. I'll end it with where I started. At some point, it won't be time to do this. But as it showed last week, we are still in the buy the dip mentality. When the buy the dip mentality stops, you'll probably know it because things will keep going down. On that note, have a great day. Thanks again, everybody that came out to see me. I had fun on the boat, fun at dinner, and I'll look forward to doing it again probably in 2018. Thanks, everybody. Have a great weekend. What's left of it.